Hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We are in our second week of the fall 2021 semester, and we are covering long-term assets and the balance sheet in this week. The first topic of discussion is the long-term assets. As a reminder from those of you who have taken Principles of Accounting 1, is long-term assets are assets on the balance sheet like property, plant, and equipment that last longer than 1 year. The concept of long-term assets, such as property, plant, and equipment that live greater than 1 year, are depreciated over time. Depreciation comes from the loss of usefulness of these long-term assets, like property, plant, and equipment. Long-term assets, like property, plant, and equipment, are classified as either fixed assets, an investment, or an expense based on the individual business and their practice over time. There are a few steps that we must follow as we classify costs that involve the classification of long-term assets to understand how those long-term assets are classified. The first step is to identify if the long-term asset is long-lived. Long-lived, meaning greater than 1 year, is important to identify as we classify long-term assets. In step 1, if the asset is long-lived, we classify that on the balance sheet as a fixed asset or an investment. The difference between the two is if a long-term asset is classified as a fixed asset, it is used by the business to generate revenue. If the asset is classified as long-lived and as an investment on the balance sheet, it is classified as an investment because it will be sold in the near future to generate revenue. If neither of those are true, we classify the purchase of an asset as an expense. Expenses, as you know, show up on the income statement of a company. If yes, from step 1, we proceed to step 2. Step 2 is the asset used in normal operations? Normal operations of a business means the day-to-day operations of the business. If the asset is used in the day-to-day operations of the business to generate revenue, we record the asset as a fixed asset on the balance sheet. If not, then the asset is classified as an investment. This slide represents the decision tree of both step 1 and step 2. Items that are classified and recorded as a fixed asset on the balance sheet include things like property, plant, and equipment. Property, plant, and equipment commonly last for longer than 1 year and are used in day-to-day operations of the business. Investments that are classified as a long-term asset are not used in day-to-day operations of the business and are held for resale, which is the concept of an investment. An investment is an asset that is held for resale in the future to generate revenue. Here are a few examples of related costs associated with long-term assets. Looking at building, a building asset includes costs such as architectural fees, engineering fees, insurance fees, interest fees for cost of borrowing, sales tax, repairs, reconditioning fees, modifying for use, permitting fees, so forth and so on. Anything related to the cost of building a building. For equipment and machinery, costs associated with the acquisition of machinery include things like sales tax, freight, installation, repairs, reconditioning, insurance, assembly, modifying for use, testing for use, and permit from government agencies. All of these costs are associated with the acquisition and maintenance of machinery. With respect to maintenance of machinery, we consider maintenance either as a reinvestment into the asset or an expense. This cost, it relates to the type of maintenance. If the type of maintenance adds to the value or to the useful life of the machinery, we consider it a cost of the machinery. If the maintenance simply relates to maintaining the machinery, then it is an expense. An example of this would be the overhaul of a transmission. If the overhaul of a transmission is incurred, that would relate to the increase of longevity of the machinery and therefore a direct cost to the machinery. If the maintenance cost is simply an oil change is correlated with an expense to simple repairs and maintenance. As you know, expenses are recorded on the income statement, and machinery is recorded on the balance sheet as an asset. With respect to land, land is the physical land that the building and machinery sit on. The cost of land involves the purchase price, sales tax, permitting, broker's commissions, title fees, surveying, real estate tax, removing of unwanted buildings, grading and leveling, so forth and so on. As you can imagine, there are a lot of expenses related to the acquisition and clearing of land. Land improvements that are correlated with land would involve landscaping, fencing, outdoor lighting, and paved parking lots. The cost of acquisition meaning how the company has come to obtain the asset, are related to the cost of the asset on the balance sheet. Otherwise, they're classified as an expense. Expenses are incurred as they are related to the fixed assets based on the occurrence. What that means is if there is relevance occurrence as it relates to a fixed asset, we classify that as an expense. Relevance occurrence would include things like an oil change on a piece of machinery. That is simply an expense because it deals with maintaining that asset. The cost of the asset includes things like installation, setup, the acquisition cost of that piece of machinery, etc. The idea is the direct cost of an asset includes all of those things, right? It's the cost of getting it set up for operation to generate revenue. Otherwise, it's classified as an expense. If it's an oil change, vandalism, mistakes in installation, theft, damage during shipping, all of those things Those are all simple expenses as they relate to the fixed asset. To show you this in an example, our company recently purchased a piece of equipment for $12,000. The cost of shipping that equipment to us is $600, and the cost of installation was $1,500. During the installation, however, there were errors made that resulted in damage to the equipment. From that, we subtract $500 as a result of those errors. So, to show you in this journal entry, we debit equipment to increase our asset account, which is our equipment, by the purchase price plus the cost of freight, the cost of installation, minus any errors made. And we credit cash to reduce our cash account. The cost of a fixed asset relate in the direct costs incurred by that asset, such as acquisition, materials, labor, any other capitalized cost. In the example of putting up a building, there's a cost of construction. The cost of construction includes things like labor, direct materials, and factory overhead. Construction costs that complete the construction of the building are debited to fixed asset accounts, such as building, and credited cash to reduce cash. As I had said earlier, fixed assets depreciate over time. They lose their useful life. Because of this, we must account for the loss of useful life through the process of depreciation. Useful life tells us how long an asset is expected to be useful. An example of this would be a dump truck. Our company purchased a dump truck for the amount of $25,000. The useful life of that dump truck is expected to be 5 years. 5 years useful life was given to us by the MACRS report generated by the Internal Revenue Service of the United States. The maker's report tells us, on average, how long something should be alive for. In the case of the dump truck of $25,000 value is expected to live for 5 years. Using the straight line depreciation method, we depreciate the value of that dump truck over the course of 5 years. We simply take the cost minus residual value divided by useful life to find the depreciation per year for 5 years. That is straight line depreciation. In this example, $25,000 minus 0 residual life divided by 5 years is depreciation of $5,000 per year for a period of 5 years. That is how depreciation works. The same concept can be applied using other factors of depreciation. It doesn't always have to be 5 years. It doesn't always have to be straight line. Other methods of depreciation include double declining balance. They also include things like market value depreciation or units of production. All of these factors depend on how the company allocates the depreciation of the fixed asset over time. Depreciation is caused by physical and functional factors that erode the fixed asset over time to make it less useful, which is how accountants decide on the factors of depreciation. Depreciation used in accounting identifies how the asset is declining over time. I had given the example of straight line depreciation using a dump truck valued at $25,000 over 5 years. The dump truck over 5 years, $25,000 divided by 5, giving us $5,000 per year for 5 years until the value was zero, which is the end of its useful life. Although we expect the dump truck to last more than 5 years. Depreciation measured may not only just be in the factor of straight line. Businesses often choose the method of depreciation based on the asset that is being depreciated. I use the example of a dump truck to simplify things, but you can use that same example in the form of market value or double declining balance or units of production to depreciate the value of an asset. Calculating the depreciation includes obtaining the following information: the initial cost of the asset, the expected useful life, and the estimated residual value. Earlier, I had given the example of the dump truck. The initial cost was $25,000. The useful life was 5 years, and the estimated residual value was zero. Using straight line depreciation, meaning the asset of the asset depreciates the same amount over the useful life, would result in a $5,000 depreciation per year for 5 years. Initial cost $25,000 minus residual value of zero divided by 5 years, $5,000 per year. That's straight line. And of course, there's other methods such as double declining balance or market value or units of production. The expected useful life of the asset can be lengthened depending on improvements of the asset, such as an engine overhaul. And that's something to discuss later on. The estimated time of the asset is placed into service. What this means is the Internal Revenue Service or other industry standards tells us how long something should live. I had mentioned that our dump truck, in our example, lived for 5 years, or the expected useful life is 5 years. We fully expect it to last longer than 5 years. However, according to the IRS, the MACRS, the Maker's Report, tells us that the useful life is 5 years. For tax reasons, companies will depreciate the value of assets based off of the Maker's Report in order for that company to then deduct the value of the depreciation from their estimated tax report. And what that does is it provides a, how do I want to put this? It provides a tax deduction based off of the useful life from depreciation. Oftentimes, companies will select the method of depreciation based off of their estimated tax savings. It's very true. So oftentimes they use the Maker's Report to determine the depreciation. Otherwise, they will use estimates provided by industry associations. Residual value. Residual value is the expected value of the asset at the end of its useful life. Oftentimes, this is also called scrap value or salvage value or trade-in value. To put this into context, think of your personal automobile, your vehicle. Your vehicle will oftentimes have what they call a scrap value or a salvage value or trade-in value. Scrap and salvage are typically determined if the vehicle is wrecked during its useful life. Trade-in value is what the automobile dealerships use to determine the remaining value of its useful life, right? And so that is how residual value works. It's what is the value of the asset at the end of its useful life or its estimated useful life. And this is determined at the beginning when the asset is placed into service. So to use it in a personal example, the second you drive the vehicle off of the lot from the dealership, it begins the process of depreciation. And that is the residual value at the end of the vehicle's useful life. The difference between the fixed asset and the initial cost is oftentimes called residual value as well, or its depreciable cost. Oftentimes, when we purchase an asset, it is above what we call market value. The individuals selling the assets need to make a profit somehow, and that is included in the asset's initial cost. Remember, the initial cost is what it costs for you or the company to acquire the asset. It's oftentimes what we call the landed cost. It's the cost of acquisition, right? And the cost of putting it into service. Minus its residual value is the depreciable cost. The asset cost is allocated over its useful life using either straight line method, double declining balance, or units of production. If the fixed asset has no residual value, then we enter it as zero. So initial cost minus zero divided by useful life to find the straight line method. I've been saying that there are three primary methods of depreciation: straight line method, units of production, double declining balance. These are the three primary methods used for calculating depreciation. Using another example, let's say this is a forklift. Our company recently purchased a forklift for the value of $24,000. We are told that at the end of its useful life, it will be worth $2,000 of scrap value, which is basically the value of the metal components. We expect that the forklift will last for a total of 5 years. $24,000 initial cost minus residual value, $2,000. That gets us to $22,000 divided by useful life of 5 years, giving us an annual depreciation of $4,400. I just want to confirm, Georgina and Michelle, you're both okay so far, right? Are there any questions?
No, I'm okay.
You're
I think
okay.
I remember this from my last accounting class.
Got it. Perfect. I'm glad to hear that. Michelle, you're all right. I'm sorry, Michelle, I can't. I got you.
Yeah. I've had to actually. Oh yeah, no, I'm good. I've done this in real life actually, so it's good to see the method behind it. Usually.
Got you. Thank you so much for sharing that. I do appreciate it. It's reassuring to hear that people are using these concepts. You know, we've been teaching this for a long time. You know, accounting has been around for thousands of years, and I mean thousands of years. The concept of depreciation has been, we started depreciation concepts around 1960-ish. in the United States through the generally accepted accounting principles. And it's just very reassuring to hear that it's being utilized in the way that it should be. And when I owned my own company, I did the same thing. So it's really good to know that. And I appreciate your feedback, Michelle.
Yeah, because the beauty of learning this is that the system usually does. The system with Maker streamline you what the answer is, but to take class and learn how we get the answer is the important part, right?
Exactly right. Yeah, 100%. And in practicality, when we put this into practice, into implementation, that when the company has the ability to deduct it from their bottom line that through taxes, that's a real benefit, right? And it's important that we get that number right. So, but yeah, I really appreciate your input and your feedback. So as we continue, we just covered the straight line depreciation method, which is the most commonly used, by the way. Straight line depreciation, well, I shouldn't say that. Straight line depreciation and double declining balance are probably the most common ones. And a lot of time, the reason for that is because of tax reasons and the deduction methods that are allowed from the IRS. So looking at this second method, the units of production, I call it units of production. That's what it's most commonly called. Units of activity is another name for it. The units of production is based off of the utilization of the asset, the utilization of the asset. For example, if I purchased let's say I purchased a forklift for $24,000, and on average, I drive that forklift for 50 hours, because most machinery is measured in hours. Vehicles are measured in miles, and other machinery might be measured in hours or wattage or some other unit of activity, right, to measure it. And like lawnmowers, forklifts, other pieces of machinery are measured in hours. Vehicles are measured in miles or kilometers, depending on where you live. And other pieces of machinery might be measured in the wattage being utilized. And we call this units of activity because the depreciation is based off of that unit, the usage, right? And that's why we call it units of production. That's why it's best called units or units of output sometimes, right? So there are two primary steps to calculating the units of production. The first is we take our initial cost of the asset minus residual value divided by the total estimated units of activity per year. Well, actually, I think it's total. And then you multiply it back in. Yeah, total. Step two, we take the depreciation per unit that we got from step one, multiply that by the activity per period. So per year. So for example, let's say we have our forklift 22,000 or 24,000 minus residual value 2,000. So 22,000 divided by 30,000 hours of total useful life. We would take that amount, which is the depreciation per unit, times the number of units per year to find the depreciation expense per year. That's units of activity. It's very straightforward. The double declining balance. This gets a little bit more complex than the other two methods, but we use the straight line depreciation method to calculate double declining balance. The reason why companies select double declining balance over straight line as they're calculating their depreciation is simply for tax reasons, because companies are able to deduct more in their first year than they are in subsequent years. based off of the usage of that asset. Sip of coffee. Here we go. Okay. There are a couple of steps that we need to follow in order to determine double declining balance. The first step is to determine the straight line percentage. Okay. This is relatively simple. We take the straight line value, or we take cost minus salvage value divided by useful life, and we multiply by 100 to find the percentage. Okay. Step 2, we determine double declining balance by multiplying by 2 to find straight line rate. And step 3, we compute the depreciation by multiplying double declining balance rate times the book value of the asset. So in summary, in this chart kind of shows us the difference between the three methods. The most commonly used by most companies is either straight line method or double declining balance. The reason for that is for tax deduction reasons. You won't be tested on that. It's just good to know, right? You know, as a business owner myself, it's very important for us to understand how best to maximize our tax deductions in order to generate the lowest tax value possible, right? That's a big part of it. Now let's talk about the statement of cash flows. The statement of cash flows, most of you probably recall from Principles of Accounting 1. The statement of cash flows represents the utilization of physical cash within the business. There are three primary categories for the utilization of cash. First is operating activities. Operating activities represents the day-to-day operations with the utilization of cash. The second category is called investing activities. Investing activities represents the purchase or sale of property, plant, or equipment using cash. And the third is financing activities. Financing activities represents the utilization of cash for the purchase of sale of stock, or the distribution or investment of cash from ownership, or things along those lines, right? Oh, sorry, went a little too fast. Managers use the statement of cash flows to understand planning for the future as they relate to investing and financing activities. The external users use this information, investors, right, creditors, to assess the company's ability to repay its current and long-term debts. Operating activities, as I had mentioned, is the day-to-day use of cash for operations, day-to-day, right? Operating day-to-day. That's how we run the business. Yeah. Examples of this would be the purchase of merchandise for sale by a retailer, or it could also be the company is receiving cash from the sale of inventory to customers. You know, day-to-day operations. You know what I'm talking about. Where the company's paying its bills, companies receiving cash from customers from the sale of goods. Day-to-day operations. Investing activities results in the purchase or sale of property, plant, and equipment. Financing activities results in the issuance or retirement of equity, so forth and so on. Here is a simple flow of the statement of cash flows. We have net operating activities plus net investing activities plus net financing activities, resulting in the change of cash flow, plus the beginning balance period equals the end period of cash flows. This is very, very simple format. How do we find the net, you might be asking? Beginning balance minus ending balance equals net, right? We'll talk a little bit more about how that's broken out. The source of cash results in the actual physical cash, right? Cash coming into the business is classified as cash inflow. Cash going out of the business is called cash outflow. Very simple. It's important we understand the terms. There are sources of cash flow. From operations, cash coming in is the sale of products or services. Cash going out is the payment of bills, the payment for inventory, the payment to employees, the payment of taxes, operations, right? Day-to-day operations. Cash coming into the business from investing is the sale of property, plant, and equipment. Cash coming out of the business is the purchase of property, plant, and equipment for investing activities. Financing coming into the business is the issuance of long-term liabilities or stock. In other words, we're acquiring a loan or issuing stock, which both result as cash coming into the business. Cash going out of the business for financing includes things like paying dividends to stockholders, repurchasing stock, or repaying long-term liabilities. There are two methods to the statement of cash flows that you have seen so far, the direct method and the indirect method. And the formatting of these for the statement of cash flows using direct or indirect method include the use of net income. So if we using the direct method, direct is, in my opinion, the most simplest format to use. We have cash coming in from our customers as a result of sale for services or goods. And we have cash going out of the business to pay for things like inventory, operating expenses, interest expense, income taxes, you name it, right? Cash going out of the business for whatever reason. So cash coming in minus all of the outflows equals the net cash flow from operating activities. And you would perform the same exact format for operating, investing, and financing activities. That's the direct method. And that is the simplest method. Cash coming in minus cash going out equals net cash, right? That's very, very straightforward. That's why we call it the direct method. The indirect method is a little bit more cumbersome, and it's because it involves the net income. It's the net income minus the net, which is or the adjustments too, right? So net income plus cash coming in minus cash going out equals net, and that it's a little bit more condensed and it's a little bit more cumbersome, which makes it a little bit more difficult to calculate. However, I'll also point out that both the direct and indirect method of calculating cash flow will be the same. The net will be the same. There is no difference between the two. It's just the formatting of the two and understanding what goes in and out of each one. Now, there's reasons why managers are interested in seeing either or, right? The direct method is more preferred for managers who are interested in seeing the differences between cash coming in and cash going out for individual uses. We can see that information will be important because we're analyzing that information, whereas the indirect method does not show the detail, and therefore investors might be more interested in seeing that because they're not interested in the detail. We're just kind of talking about the advantages and disadvantages of the two. That's kind of what those slides show us. So as we can see, as I had said, both using either direct or indirect method, the results are the same. It's just the difference between the two is how they're formatted and what the differences, right? What shows us the most detail. So that's operating activities. Investing and financing activities are relatively the same. We show cash coming in minus cash going out equals net cash flow for investing and financing activities. And so that will be the same for both the direct and the indirect methods. So really the only difference between the two is going to be shown in the operating activities. And that's one of the nice things about the statement of cash flows is it really does show managers and other internal stakeholders the detail level and what's being spent on what, right? That's one of the ideas behind the statement of cash flows. Okay, so here's a nice classical example of the statement of cash flows. As you can see, this looks like the indirect method being applied here. Because how do we tell? Well, if you look at the very top, we see that the operating activities are condensed. So we show net cash flow. Net cash flow for operating, investing, and financing activities all added up equal the change in cash plus the beginning cash period plus the equals the ending cash period. Result in there's a separate line item for non-cash investing activities. Non-cash investing activities represents things like trade. Sometimes companies get involved with trading pieces of land, equipment, or property for property, plant, equipment for various reasons, and there'd be no cash involved. No cash usually results in shares of ownership or shares of stock. Shares of stock in exchange for property, plant, equipment, those are non-cash transactions. There's no physical cash changing hands, just shares of ownership representing cash, but it's not actual cash, right? So that's statement of cash flows. Any comments, questions, concerns, statement of cash flows? Georgina, Michelle, you're both with me, right?
Yes. I'm
Yeah,
okay.
I don't have any questions. I know I had to produce a statement of cash flow, and I was a little confused. And the financial planner said that the way to think about it is when an outside person is looking at the books, they want to make sure that you're using your operating cash and you're not pulling cash from other places to see how the business is operating.
Yeah,
does that make sense?
It does. We call that working capital. Wow.
Okay.
So working capital, the idea of working capital is we take we're looking at how the net income of the company is being utilized, right? By not to make sure that the company is using their cash appropriately and not finding cash from other resources. We call that working capital. And in fact, we'll talk a little bit about that as we talk about financial statement analysis. But yeah, that's an excellent perception, because that is very, very common among businesses. Investors want to understand that the business is not using cash outside of their ability, right? And we call that working capital. And we'll talk a little bit about that. Excellent point. So looking at financial statement analysis, the idea behind analyzing financial statements like the income statement, balance sheet, statement of cash flows is investors and managers and other stakeholders are interested in understanding things like liquidity, solvency, and profitability. The idea of a company being liquid means the company has the ability to turn their assets into cash quickly to resolve any short-term liabilities. Solvency represents the company's ability to satisfy both the short-term and long-term liabilities using total assets. That's what solvency is. It basically represents the company's ability to go out of business without stress on stockholders, shareholders, and other stakeholders. Profitability represents the company's ability to generate a profit using assets. So let's take a look at liquidity first. Liquidity represents the company's ability to convert short-term assets into cash, right? And it also represents the company's ability to pay its short-term liabilities. That's liquidity. That's the idea of being liquid, right? How quickly can I turn my current assets into cash to satisfy my short-term liabilities? There are there's three primary calculations that we look at with liquidity. There's working capital, which I just talked about. No, we'll go into a little bit more detail, Michelle, on that one. The current ratio and quick ratio. Those represent the company's ability to repay its current debts and to utilize their assets appropriately without going further into debt. And that's what most nonprofit organizations are concerned with. The second subset of ratios include things like the accounts receivable turnover and number of days of sales in receivables. What this tells us is how quickly I can convert my receivables, my accounts receivable, into cash. And inventory analysis includes things like inventory turnover and number of days in inventory. That tells me how quickly I'm selling my inventory, right, in order to convert that into cash. These are all liquidity. Let's take a look, deeper dive into working capital. As Michelle had mentioned, most nonprofits are concerned with the concept of working capital. This represents the company's ability to use its current assets to satisfy its current liabilities. So how do we determine that? Well, you take current assets minus current liabilities, both of which are found on the balance sheet. And what this also tells us as investors or as stakeholders within a nonprofit organization or any other type of organization for that matter is what is the company's ability to satisfy its current liabilities? And that is for sure a major concern of most investors. Along those lines, we also look at things like the current ratio. The current ratio is current assets divided by current liabilities. And this is represents the company's instant ability to pay its current debt. This is also sometimes called the quick ratio or the asset test ratio, which is why you see current ratio and quick ratio being the same. It represents the company's ability to satisfy its short-term liabilities within a quick amount of time. That's why we call it current, right? It also represents the current assets being quickly converted to cash and the ability to satisfy its current liabilities. And in most situations with a current ratio or a quick ratio, anything above 1 is typically considered good, right? 1 and above, good, yes. The current assets greater than current liabilities essentially means, yes, the company has the ability to repay its current debts and it also has the ability to quickly convert things into cash. And so with that, anything above 1 for the current ratio or the quick ratio represents the company's ability to quickly convert things into cash. So that's liquidity. Solvency. Solvency represents the company's ability to go out of debt without the need to satisfy with the need to satisfy all of its long-term debts. Solvency. The idea behind solvency simply means that all of my total assets will satisfy all of my total liabilities. That's what solvency is, right? I can repay all of my debts. That's what solvency ultimately represents. There are three primary ratios that we look at when calculating solvency and determining the ability of a company to be solvent. First is fixed assets to long-term liabilities. The second is liabilities to stockholders' equity. And the third is times interest earned. Looking at the first ratio, fixed assets to long-term liabilities, we take fixed assets, divide by long-term liabilities. Fixed assets, as you know, found on the balance sheet toward the bottom of assets. Fixed assets being long-term assets, right? Divided by long-term liabilities greater than 1 year. Higher than 1 represents a good solvency. Liabilities to stockholders' equity, total liabilities divided by stockholders' equity. In this case, less than 1 is typically good. Times interest earned is income before interest and taxes plus interest expense divided by interest expense. You might be thinking to yourself, oh, Dr. B, where can I find income before income tax? That will be found on your income statement. The interest expense also found on the income statement. So you can easily say that the times interest earned ratio is used by utilizing your income statement to calculate. The third area of concern for any business is profitability. What is the company's ability to generate a profit using its assets? That is always a concern for any investor. I would never invest in a company that does not have the ability to generate revenue using its current assets. And we can identify the relationship between operating results and their assets by calculating profitability ratios. Oops, apologies. So here's a few profitability ratios that we typically calculate in order to understand if the company has the ability to generate a profit. First is the asset turnover ratio. We take total sales divided by average total assets. Here's a couple of keynotes here. Sales is revenue. Sales is revenue, okay? So revenue is the top part of your income statement. The average total assets. To get the average of pretty much anything in accounting, we take beginning balance plus the ending balance divided by 2 to get average, okay? Beginning balance plus the ending balance divided by 2 to get average. So sales, which is revenue, found in the income statement, divided by average total assets. Your beginning balance plus ending balance divided by 2 represents the asset turnover ratio. Return on total assets, another ratio. Net income plus interest expense divided by average total assets. Net income found on the income statement. Interest expense found on the income statement divided by average total assets. Beginning balance plus ending balance divided by 2 to get average total assets. The return on operating assets, another wonderful ratio. We take operating income divided by average operating assets. Okay, this gets a little bit more muddy. Operating income is this, you can use the same concept of gross profit, meaning operating income. This is the income before taxes, before interest. before interest and taxes is operating income. Okay. So it's your revenue minus your expenses before interest in taxes. Typically, this is found toward the end of the income statement, divided by average operating assets. Operating assets are your property, plant, and equipment.
I'm sorry, when you say minus taxes,
Mhm.
what is that?
So before taxes, so operating income is your revenue minus your expenses before you get to interest and taxes. So if you look at an income statement, toward the bottom of the income statement, before we get to net income, you'll find line items like interest expense and taxes. The taxes are the taxes that we pay based off of our income, right? And oftentimes businesses will report their tax expense on the income statement.
Oh, okay, I understand.
Cool, awesome. Yep. So operating income comes before interest and taxes. There's a line item oftentimes that you'll see. It's called EBIT or EBIT. Oftentimes this will be reported by investors or investor relations. EBIT simply means earnings before interest and taxes. And that is a very common line item that you'll find on the income statement. They call it EBITDA. So a couple more ratios to understand when it comes to profitability. And we're almost done, by the way. The return on stockholders' equity. We take net income found on the bottom of the income statement divided by the average stockholders' equity. Average stockholders' equity, along with the average of anything that we find in accounting, we take the beginning balance plus the ending balance divided by 2. Beginning balance plus ending balance divided by 2 to get the average. So income statement, net income divided by beginning stockholders' equity plus ending stockholders' equity divided by 2 gives us the return on stockholders' equity. That one's in, and actually these last 3 are interesting to compute because they oftentimes tell us about the company's ability to pay dividends to shareholders. The second ratio here, is, oh my goodness, I didn't realize this past 5, my apologies. The second ratio here is the return on common stockholders' equity. With this one, it's net income found on the income statement divided minus preferred dividends. Okay, preferred dividends. Preferred dividends is the dividend paid on preferred shares, right? As most of you know, as you should know, hopefully you know, and we did talk a little bit about this last week. There are 2 types of shareholders. There are preferred shareholders and common stock shareholders. Preferred shareholders are, preferred shares are stocks that are typically held by the board of directors, the employees of the company, and they do not hold voting rights, right? Those are preferred shareholders. So net income minus preferred dividends, those are dividends paid to preferred stockholders, divided by average common stockholders' equity. Common stockholders, as you recall, are, or common shares of stock, are where individuals hold common shares and they have the ability to vote, right? And it's distributed to the common public, which holds the name common stockholders. Find the average, we take beginning balance plus the ending balance divided by 2. So net income minus preferred dividends divided by beginning plus ending divided by 2 to find the average common stockholders' equity. That gives us the return, common stockholders' equity. And it's very similar for earnings per share. Earnings per share tells us what we expect to earn as a dividend per share in the future. That's what earnings per share tells us. And it's net income minus preferred dividends divided by shares of common stock outstanding. You recall the word outstanding as a result from shares. Any type of shares outstanding means shares that have been issued and purchased by individuals. That's why we call it outstanding, outside of the company. And all of those are profitability ratios. Here's three more, very similar in nature. Earnings per share ratio, market price per share of common stock divided by earnings per share of common stock. Both those will be given to you. Market price is on the open exchange, so on the NASDAQ, on the S&P 500, on the whatever, the New York Stock Exchange. This is the market price per share divided by earnings per share, which will be given. Dividends per share is the dividends on common stock divided by the shares of common stock outstanding, both of which you'll find on the 10K report. And the dividend yield is dividends per share of common stock divided by the market price per share of common stock. All of these represent profitability. Basically, the company's ability to pay a dividend is kind of the whole concept behind profitability. A couple of techniques in analyzing financial statements that we use. When you're looking at your financial statements, you'll notice, especially when you're looking at the 10K report, you'll see that on the income statement, the company compares itself year to year over the course of 3 years. On the balance sheet, it's over 2 years. On the statement of cash flows, 3 years, so forth and so on, right? The idea behind this is that we are identifying trends in the statements, the financial statements. These trends help us to analyze the financial performance of the company from year to year. We can calculate this as a percentage. And the way that we do that is we take the most recent year minus the last year divided by the last year amount. And what that does is it gives us the percent change, new minus old divided by old. That's percent change, new minus old divided by old, percent change. Percent change tells us how much each line item has changed from year to year. And that is very useful in understanding the trends of the company. That we call that horizontal. Horizontal analysis. That is called horizontal analysis of the horizon. Think of the horizon line, goes from left to right, right? That's the horizontal analysis of a financial statement. It is the percent change from year to year over time, horizontal. That helps us to identify trends in the company. We can also identify changes in the company vertically as an expression of a percentage of another line item. For example, on the income statement, I can identify a percentage of sales based off of total sales on the income statement. So total revenue would be my base, okay? And my base on the top of my numerator of the ratio would be the line item divided by the base, which is total revenue on the income statement. Base, or, line item divided by base, line item divided by base. We express everything as a percentage of total revenue on the income statement to understand the percentage of revenue and expenses based on the total revenue. And we can do the same thing on the balance sheet. Everything is expressed as a percentage of total assets. And on the statement of cash flows, everything is expressed as a percentage of net income. And so forth and so on. And we call that horizontal analysis. Now, we can also identify the difference between two different companies expressed as what we call common sized financial statement analysis. This is where we compare two individual companies within the same industry to each other that are similar in size. We call it common sized financial statement analysis. And we're comparing percentage to percentage based off of horizontal and vertical analysis for each company. And all of this information helps us to identify changes across time, to identify trends within our company. And that's the whole concept. So here's an example of the horizontal analysis that I discussed earlier. Everything expressed as a percentage of total assets. We can see how the percentages align, right? And we can see the changes. Yeah, and that's cool. I like doing that type of analysis because it helps to identify trends in the company from year to year. Vertical analysis. Here we go. So express the percentage of total assets, a percentage of total assets, and you can compare that year to year. It's just a wonderful way to identify trends within the company. So if if your boss comes to you and says, "Hey, you know what? How are you performing this year in comparison to last year?" What are you going to do, right? Well, you run the horizontal and vertical analysis to show your boss, hey, here's our percentage of total assets, percentage of sales, minus last year. Here's where we are, right? And that shows us that. And using common size financial statement analysis, as I had said, we're comparing two different companies. And this is an example of that on the income statement, percentage of total sales. And, we can see one company to another. There are competitors within the same industry. And that information helps us to identify how we benchmark against other companies in our industry. And all of that is very useful to companies over time. So I apologize for going a few minutes over, but I really appreciate your time today. Are there any comments, questions, concerns, Georgina, Michelle?
Yeah, check out a quick one. When you said benchmark, what do you mean by that?
Yeah, so a benchmark is saying, for example, in an industry might say the average total sales in our industry is $1.5 billion a year. That average becomes a benchmark. The benchmark is a goal to be attained by a company. That's what a benchmark is. It's a standard. It's a goal. It's a benchmark. That's what a benchmark is. And that can be done in an industry. That can be done by the company itself. So, like, for example, if Georgina, if the company's like, here's 5 years worth of data, we've been averaging this amount in sales. That is our benchmark. That is our goal. That is our objective, to go above that benchmark. That's what a benchmark is. It's basically, it's kind of almost made up, but it's based off of the average, right? It becomes the standard. That's what a benchmark is. Does that help to answer your question?
Yes, thank you.
Hey, my pleasure. Absolutely. Michelle, are we okay?
I'm good. I'm trying not to talk so much so that I don't run us over, but it's all helpful. This is all helpful. And I look forward to doing this the project
Cool.
now that we know how to read it better.
Exactly. And that's all I can give you as much information as possible, but if you don't know how to read it, it's not going to be useful, right? So that's what the objective is with 220 and 221. The objective here is we want you to be able to develop and interpret the financial statements, and to make objective decisions based off those statements. So, very cool. I'm so happy.
Thank you. I wish I took this class a couple months ago. We wouldn't have had to hire a financial advisor to tell us something.
Well, hey, maybe you'll be able to fire that financial advisor and you'll be happy with that cost savings. Yeah, my pleasure. Okay, so as always, if you have any comments, questions, concerns along the way, as you're working through your project, as you're working through your homework, please feel free to email me, call me, set up office hours, whatever it takes. I am here for you 100% of the time, as always. You can always reach me through the discussion forums, through the direct messaging, whatever. All of the grades have been completed for week 1. I strongly recommend you take a look at your feedback and make improvements based off of that feedback as you march forward in your 10K projects. And as always, if you have any comments, questions, concerns, I'm here for you. And I thank all of you for your time. And I wish you all the best as we move forward. Thank you so very much for your time. Bye-bye.